Good evening, everyone. Welcome to our UC Riverside Alumni Homebuyer Workshop. My name is Jason Maida. It's great to be with all of you this evening. This is our first workshop of 2026. So happy New Year to everyone. Really excited that you're going to spend some time with us this evening. This class is really designed to help guide you on that path towards homeownership, if that's one of your goals in the next year or two. So I want to provide you some tools and resources to help you on that journey. We're going to record tonight's class, so we'll be able to share back the link for not only the recorded version of tonight's class, but all of the slide decks that you're going to see tonight as well, too. Some of the different tools that we have available to you. We have a really good sign up rate for tonight's class. So we're going to have quite a few in tonight's session. We're going to be answering questions as we go through tonight's presentation. Feel free to use either the Q&A function within Zoom or the chat feature. Myself and my colleague Ken Fleck will be kind of monitoring both of those windows, and I'll answer some of your questions on air. This is a really special class for us because, in partnership with UC Riverside, we get a chance to help you, help you on this path towards homeownership, which is really going to be one of the largest financial decisions you decide to make. So it's a really important element to helping you on track to obtain that financial goal. Again, my name is Jason, and so I'll be your facilitator tonight. I'm also an originator with American Pacific Mortgage, so I work directly one-on-one with clients all throughout the country, specifically more so, though, in California. We're a leader in first-time homebuyer programs, which for many of you that are joining us from California, tonight I'll be talking a little bit about some of the first-time buyer options available through CalHFA. So we'll talk through that a little bit. There are a program that some of you may have been aware of, which is called the Dream for All program. We'll kind of talk through that a little bit in tonight's session. Our run time for tonight's class will probably somewhere be around just under an hour, but we will certainly stay here as late as we need to answer any of your questions tonight. So we really want to make this a very interactive session with you and just help kind of guide you and answer any questions that you need throughout tonight's class. Well, our talking points for this evening are on screen. You can see we're going to look at the housing market, kind of what's affecting interest rates today in today's market. I do want to spend some time talking a little bit about credit and how we can give you some different tips and tricks around credit to help get you prepared for home ownership. We'll outline some of the loan programs that are available to you, talk about savings for home ownership, which can be a little bit of a challenge for some of our buyers. Also talk about some of the first-time buyer programs available here in California. If you're outside of California, we can also spend some time looking at other state programs that are a little bit similar in the first-time buyer space. And then we'll talk about the workflow of buying a house. So after you're attending tonight's class, hopefully you're going to have a few takeaways from tonight's discussion. But where do I go from here? So I kind of want to walk you through the buying process, and then how do you get connected with us to learn a little bit more about your home buying options through our personal consultation service. All right, so that's what tonight's class is going to look like. Again, we encourage you to ask questions of tonight's class, and you can either use the Q&A or the chat feature in Zoom, and we'll be checking those out for you, okay? Well, when we think a little bit about home buying, and again, this is a major financial decision for all of you that are attending tonight's class. It's a big deal, and I know there's other things you guys could probably be doing on a Wednesday night than listening to me speak, but obviously, clearly, you understand, the importance of making a sound financial decision here. And when you look at home ownership, there's really kind of three key factors that I think make up some of the benefits of home ownership. One is affordability, right? We have the opportunity, even in a really high, valued market like the housing market is today all across the country, you still have the opportunity to create more of a fixed payment for yourself versus waiting on your landlord that's probably going to increase your rent on a monthly basis an annual basis. But obviously you would see a monthly increase in rent. This is an asset that will appreciate over time. And, real estate goes through cycles, but ultimately this asset should appreciate over time. And so as your home goes up in value from where you purchased it at, as you pay down the balance of your mortgage, we create home equity. For many of us that are homeowners, it's our number one asset that we have. So, this is truly an opportunity to create some generational wealth for ourselves. There is some tax benefits that also come along with owning a home. So when we think about tax deductibility of interest or maybe energy efficient improvements that I make on my home, those are all things that can be potentially tax deductible for me. Now, as I consult with clients in design their home buying plans, I like to walk them through a calculation. It's called our rent versus buying calculator. And ultimately, what this can kind of frame up for us is really adding in those elements like affordability, tax benefits, equity appreciation. What can that do for us when we're thinking about setting our budget for homeownership. Now, we have some really great tools that are available to you as clients within our organization. This is one of our calculators that is that rent versus buying calculator. You can see on this top header, there's other calculators that you can jump into and check out, like affordability or buying down interest rates, which we'll talk about tonight. But I want to walk you through this calculator because I do the same exercise with clients during our consultation, and it looks like this. Okay, so let's use this as a real-time example. Let's say I'm going to go out and buy a $650,000 home in Southern California, right? The minimum down payment as a first-time buyer is 3% of the purchase price. That means I would essentially finance 97% of that purchase price. We plugged in today's interest rates, which are right around 6% to 6.1. We'll spend some time diving into that a little bit more tonight. But generally, for most buyers buying at that level, they're going to elect a 30-year fixed mortgage, okay? And then what we'll do is we'll plug in, and I'll change this date around a little bit here. So let's make the assumption that we're going to buy sometime in January, right? We have mortgage insurance on our loan. We'll talk more about mortgage insurance tonight, which essentially is mortgage insurance comes into play when I put less than 20% down to purchase my home. We have homeowners insurance costs, which will vary based upon where I'm going to buy. So if I'm going to buy in a high fire zone area, probably going to be a little bit more expensive insurance versus maybe more of a possibly an urban area that's not as, fire impacted. We have property taxes involved with our home. Maybe I'm looking to buy a townhouse, condominium. Those things do have HOA dues. And then this is the component that a lot of us don't think about when it comes to homeownership. What tax bracket am I in? Because depending on where I'm at from a tax perspective, interest, mortgage can be potentially tax deductible for me. And then how much is it going to cost to upkeep my home in maintenance? Now, one day, if you're a homeowner, you're probably thinking about selling your house, right? So what are the costs for me selling my home? Because eventually, as you look at this calculator, we're going to kind of time out, like the longer I hold this asset, the more money I'm hopefully going to make in appreciation. But eventually, when I sell that asset, I'm going to pay some type of expenses to realtors or in general closing costs. And then what does it look like for my rental situation today? So in this scenario, we have someone that's paying $3,000 a month in rent. They have renter's insurance, and they're expecting their rent to go up about 2% every year. All right. So that's our kind of our side-by-side comparison. $3,000 in renting versus $650,000 in home ownership. So what our calculator tells us is we have a break-even point. So when am I going to be on the plus side when it comes to buying a house now? Well, it's going to take me 3 years to break even on my investment of buying versus continue to just put $3,000 into my landlord's pocket every month, right? So that's a really good break even. Normally, I want to see that less than 4 years. Now, where it gets exciting for you as future buyers is how I'm going to see my appreciation start to stack up and my tax savings with home ownership. So at the end of 10 years, if I was to hold on to this home, I would now have a $150,000 buyer's gain opportunity. Meaning, if I was continue to rent and pay $3,000 a month of rent, or I own my $650,000 home, by the end of 10 years, I'm $150,000 ahead financially. So if we were to kind of put this, and let's say, maybe it's not realistic to think about being in the home for 10 years, but let's say I want to be in the house for 8 years, right? Still a $100,000 opportunity for myself by owning a home versus continuing to rent and probably paying someone else's mortgage, right? So this is a really super helpful calculator. I would encourage you to walk through that exercise. And of course, as part of our consultation service for clients, we're going to walk you through it as well too. But I think it's a great exercise to frame up homeownership because I will tell you so many times clients will come to me and they say, hey, Jason, I'm paying $3,000 a month in rent right now. So I have to be at $3,000 in housing expense for a mortgage, right? But when you look at that calculator, those don't add up necessarily, right? Because if I add in the elements of appreciation, element of tax savings, really I can possibly stretch my dollar a little bit more and buy a home that really fits my needs versus maybe having to settle at a lesser purchase price, all right? Now, let's talk about the housing market. What's going on with it? Now, it's an interesting time of year right now because it is January, the 14th? So we're still new into 2026, but I will tell you there's a lot of activity in the market. We're seeing a lot of buyers that are starting to go out in full force in anticipation of what I think is going to be probably a pretty busy spring buying season. Now, if we were to look just at the Riverside housing market, you can see there's a downturn in sales price. I will say there are some overpriced homes out in this market, and that's not just in Riverside, but that's in many areas across California where we've kind of had some sellers that have overshot the market a little bit. maybe they price too high. Those homes are on the market for 30, 45 days. You can see them on some of the Zillow listings or Redfin listings that you've bookmarked, especially those that put homes on the market in November and December, which historically are slower months. So I think that's really what's attributed to a little bit of the downslide in prices out there. You're seeing buyers that are coming in maybe a little bit more aggressive to undercut price. You may see that house listed at 650. Buyers are coming in and making offers at 630, and the sellers are saying, hey, yeah, I think I'll take that. Or, the buyers are coming in and say, I'll buy the house for 650, but I also want $15,000 in credit from the seller to cover things like closing costs. So those are real-time things that are happening in today's market. And I think, it's not necessarily a full-on buyer's market, but there are some elements to today's housing market, especially when you see 52 days on the market, that are leading to more of a buyer's market. And, we will see what happens with some of the activity levels with buyers. But as interest rates start to trend down, and we're going to talk about that in just a minute, we are going to see probably some more competition out there for our buyers as they get more active in the market. When we look at 2026, we're looking at, in some regards, as a little bit of a reset in the housing market, especially on the mortgage side. We've been in such a high interest rate market for so long. We've been through the 8% days, 7.5%, 7%, finally broke into the sixes, and now we're on the verge of maybe being consistently below 6%. So we're starting to see some normalcy, if you will, in the housing market, which is obviously a good thing that we're looking for. Our price growth that we're looking at, we're thinking it's going to be a more of a modest growth this year. We won't see any big jumps in housing values. I think we look at some markets that are a little bit overcooked right now. We're seeing some price corrections in certain markets that have just jumped up super high. If I look at some of the Bay Area markets, we're starting to see a little bit of a trimming in purchase prices that we haven't seen in the past 2 to 3 years. We might see inventory improve a little bit. Builders are trying to, put more homes on the market out there. But let's face it, in today's economy, the building costs are significant for home builders. So many national builders that are out there right now are kind of building to suit, which basically, they're looking at, buyers that are saying, okay, hey, we're going to put our deposit down. Now we're going to start building. They're not building, mass amounts of homes and, having 20 or 30 homes sit on the market waiting for buyers to come. That's just not the case of what we're seeing in the market. But, we do need more supply out there to support our buyers' demands. And I think spring buying season is going to be pretty active for most that are out in today's market. And so as we have limited supply, if buyer activity pushes up, then you could see, that modest growth in prices. And so, we'll have to see how that ultimately impacts the market. Here's a quick forecast of the California housing market so you can kind of see where things are going. We're seeing a little bit of a resale jump in price. You can see the median price jumping there. So about a 2% change in price year over year from what we experienced in 2025. You can see our median price increase slightly with a 3.6% change in median home price. And a housing affordability still ticking up. California is still an expensive state. And then this is the welcome side here, which we're going to talk more about interest rates in just a second, but rates ticking down from an average of 6.6 in 2025 down to 6% in 2026. We're already knocking on the door of 5.875% interest rates today. Just late this afternoon, we saw oil prices dip pretty significantly, which is a strong shot to the arm for mortgage-backed securities. So improvement in interest rates based upon some of the conflict that's going on in Iran right now. And so that was, a welcome side on the interest rate side. So we could walk into seeing interest rates in tomorrow's market at 5.875. And that is kind of one of those levels that kind of it's a psychological level of interest rates for buyers. If you can see something dip below 6%, it kind of gets you excited, right? It makes you want to jump in the market. This is a look at interest rates for the last 3 years. And you can see this will take us through the end of 2025, but we have like Q1 of 2022 out here. And this is kind of the roller coaster ride our lending industry has been on for the last 3 years, unfortunately. This is the peak of interest rates touching over at 8%. And then we've obviously come down off of that. We started our lowest levels. We were all excited here back in August of 2021. We were thinking, okay, yeah, interest rates, we're really excited where they're going. But then we saw interest rates certainly kind of creep back up, and then we've kind of just been on this bumpy roller coaster ride. And then just below this, you can see kind of like what we've seen in interest rates historically over time, going back to the 70s. Okay. So that gives you kind of an insight of what we're seeing on interest rates. Ultimately, what's driving interest rates today is the levers that the Federal Reserve is trying to pull to combat inflation. And they're watching really carefully what's going on in the jobs market right now. So the last inflation report we got earlier this week showed kind of, inflation being in line with expectations. Now we're kind of turning our attention to what's happening in the job market. So we're looking to see if the Feds are going to make one more cut in interest rates, maybe at the next upcoming meeting. But we're watching keenly what's happening. I would say for our class here, when you hear that the Federal Reserve is going to cut interest rates, we have much of that already baked into the mortgage interest rate market. So it's usually mortgage interest rates will drop as a precursor to Jerome Powell announcing the cut of interest rates. But what it does do immediately when they make a cut to the federal funds rate, it's going to drop credit card rates, some of your savings rates, student loan rates, auto financing, things of that nature. All right. Now, on the mortgage interest rate side, there's different characteristics that make up interest rates, things like credit score and eligibility for a program, how much you're going to finance with us, the down payment. You do have the option as a consumer to buy points, which is essentially paying more money out of pocket to drop your interest rate. And then the term of your loan that you select can also influence your interest rate. Normally, for a first-time buyer, we're electing a 30-year fixed mortgage because that's going to give us the lowest amount of payment. But if you shrink that term down to, say, a 15-year loan, that can also provide a possible lower interest rate option for you. Now, as I get a chance to meet with our clients for their consultations and design their home buying options, we're going to figure out like what's the right product match for you, whether that's a conventional loan, FHA, VA loan, first-time buyer product. All of those things we're going to talk through to design strategically the right plan for you around home ownership. Now, in that conversation I have with clients, we talk about credit. And credit is one of those things that can influence our interest rate, the product selection, even the cost of mortgage insurance for home buying for us. So every product that we offer as a lender has a minimum credit score requirement. And you can see those products up on screen. We're going to dive into those in just a little bit so we can get a little bit more of a understanding of different characteristics that make up those products. When we think about score factors, things that are going to be bigger hits to our score, inquiries, late payments on our credit. Maybe we have an account that was written off to a loss by the lender. Those are all big event items that can impact really negatively our credit score. So we're going to talk more about that tonight. We'll spend some time talking about credit utilization in just a bit, which is essentially looking at revolving credit balances. What do those look like in relation to the credit limit that my lender or bank is giving me in available credit, right? Now, one of the things that many clients don't realize is that when you close out an account, so a revolving account, that gets closed out, you do two things that could possibly negatively impact your credit score. One is you basically take all of that history that you've had with that creditor and it gets eliminated from the credit model. So it could actually zap your credit score. So you got to be very careful with that. Two is you also lose an available credit line that's being factored into your credit utilization. So you want to be really cautious with that. In the lending world, we do look at all three agencies reporting. So you guys know all the different agencies that report, right? TransUnion, Equifax, Experian. All of them have different risk models and they all report back different scores, right? There's also three different models to scoring. There's auto financing. So if I'm going to go buy a car, there's that model, credit card model. And then of course in housing, there's the mortgage model. That model I'm going to show you in just a second, but we look at all three scores for credit. So if my highest score is 780, let's say my middle score is 760, my lowest score is 720, then as it comes to qualifying for financing, we're going to look at that 760 credit score to determine eligibility. Now, if I'm applying by myself, right? But let's say I have my partner that's also going to join me for the financing, but my partner has a lower credit score. In fact, this is one of my conversations in a consultation earlier today, which is that their score is 680, 660, and 640. Well, their middle score is 660. That's the lowest middle score between the two of us. That is a score that we would be using for qualifying purposes. And that could switch us from a conventional loan to maybe an FHA loan. But we'll talk and have that conversation about, how we would recommend designing things, because maybe it could be a scenario where maybe only one person applies, but it still gives us the buying power that we're looking for our home purchase. I mentioned to you a little bit about negative items on your credit report. So this is a matrix, I should say, that shows you how long those negative items will stay with you on your credit report. Now, generally speaking, the negative item or event that shows on your credit report will have an impact in the most recent 12 to 24 months from when the date of the event reporting. So if I missed my student loan payment because it came out of forbearance and I forgot to make it, I was late 6 months ago, well, guess what? That's probably going to have a pretty big impact on my score. But if that was 3 years ago, it's probably seasoned out of my credit score. It still shows up on my credit report, but it's probably seasoned out of my credit score, so to speak. All right, so this is the model of credit scoring as it relates to the mortgage model. And so when we look at these different sections, I'm going to walk you through this because hopefully it's helpful for you as attendees of our class to understand, exactly what's my area of opportunity to improve my own credit score. Before I dive into that, I did just get a question that came in. I just want to kind of answer it real quick, which is, if I know I want to buy and hold a property for 10 years, would it make sense to select an adjustable rate mortgage that has a low initial interest rate that doesn't change until after 10 years? Would the initial rate of the ARM be lower than a fixed 30-year rate? So we're going to talk more about interest rates or programs, I should say, in just a little bit. But in today's market, adjustable rates are really close to what a 30-year fixed rate looks like. So the trade-off, if you will, is probably not worth it. In a normalized market, you will see adjustable rates be 0.5% to maybe 0.75% lower in interest rate or introductory rate than a 30-year fixed mortgage rate. But if you're looking to the hold strategy of 10 years, I would not do an adjust rate. If you're looking to hold for 3 to 4 or 5 years, maybe if there was enough price benefit from that strategy. But especially as first-time homebuyers, I'm not a fan of adjustable rates unless you just have to do it because you're trying to create the best affordable situation for yourself. The problem is it does create a risk for you because let's say the market doesn't turn right for you, interest rates go up, or let's say you see the housing market dip a little bit. Now you don't have as much equity as you did when you first bought the house. Those could be elements that, when that adjustable rate now adjusts up, it might make the house less affordable for you. So I'm a big fan of 30-year fixed mortgages for first-time buyers. All right, so let's talk about score calculations. So we'll walk you around this wheel here that you can see. The first one is length of credit. That's essentially how mature is my credit file. How long have I had credit accounts open? The longer I have that, probably the better my credit score is going to be. Next component is in-use credit, which basically means, am I trying to open up new accounts, right? I really want to limit, especially in the most recent 6 to 12 months, the opening of new accounts and allowing creditors to do hard inquiries on my credit. A hard inquiry will impact your credit score. Now, there are rules in lending for both mortgage financing and auto financing that says that I have a window of time of 30 days to apply with as many lenders as I want. And it's the equivalent of one credit inquiry hit to my score. Now, our approach to credit inquiries is a little bit different with APM. What we do is we only do a soft credit check at the initial application. The reason why we do that is because many of our buyers that come to our classes and we design their home buying plan for them, they're probably on a longer timeline to buy, maybe 1 to 2 years. So we want to guide you, understand more about your credit, but not necessarily impact your score. And so that's why we choose to always do a soft credit check, which is a little bit different than most lenders do in the mortgage space. Continuing on here, we've talked a little bit about this, credit utilization. How much do I owe on my revolving debts? So our kind of rule of thumb is we really want credit balances to be at 10% or less to optimize our credit score. 30% good, 50% now we're seeing probably some pullback in our credit scores. So meaning if I have $5,000 in balances on my credit cards and my limits are $10,000, at 50% utilization, I'm probably seeing some pullback in my score. But as I whittle that down to 10%, that's when I start getting the higher credit scores. That's when you see clients that are 800 plus credit scores because they have good control in that credit utilization. Here's my tip for us tonight in class around managing utilization of credit. When you look at one of your credit cards and let's say you see a due date of the 5th of the month, right? Well, there's going to be another important date there. It's called the statement or billing cycle date. If that lands, let's say on the 20th of the month, that is the date that the creditor is going to report out your activities to the credit agencies. So my tip for our class is try to pay down your balances before the end of that billing cycle date closing out. Because if you can do that, now you've kind of lowered that balance before they've reported out to the 3 agencies. Therefore, you have a lower utilization, higher credit score, especially if you're getting ready to apply for something. That's a great approach to have. It's the new year, right? It's 2026. Many of you have maybe some financial goals that you've set for yourself. Managing down credit card debt with that approach can be a really great approach to doing that. And we can talk more about goal setting for this year and whatnot, but the biggest area of opportunity for most of our clients as they're preparing to buy is around this section of their credit score model. Last one is going to be payment history. That's essentially how have I paid my bills. If I've had late payments, they rate them as 30-day lates, 60-day lates, and then 90+ day delinquencies. The more severe on that spectrum of lates I'm at, higher impact I'm going to have to my credit score. Student loans come up in my conversations with clients throughout our consultations, right? Just because, student loans are real. Some of us might be in forbearance, some of us might be in deferment, some of us might be in active repayment, right? Now, when we look at that debt, there's kind of a filter that we have to put on it as a lender, which basically looks like this. If I'm in the income-based repayment program, and let's say I'm paying $75,000 in debt, that 250 payment that I have on screen here, if that's my income-based repayment, that's what I pay or qualify, I should say, with on my mortgage. Now, many clients that I work with still are in forbearance or deferment, and by default, on a conventional loan with Fannie Mae, we have to count 1% of those balances as the minimum monthly payment. If they're doing an FHA loan, it's 0.5% of the aggregate balances as the monthly payment. So I was just having this conversation with a client today. They're not in active repayment, but they have, $100,000 in student loan debt, right? Well, I still have to count that $1,000 as a monthly payment, even though they're in forbearance right now. And so those are things that we just want to make sure that we keep in mind. Even if you're back in school and you're in deferment because of that, we still have to count those minimum payments for qualifying. Those are conversations that we're going to have as we build your home buying plan for you. All right, I'm going to take a quick pause here because we're going to dive into loan programs. It's going to give you some characteristics of programs. As I take that pause, any questions from class so far that I can help answer? I know we got a couple that came in. I saw Ken answered one for one of our classmates here. Any questions that you guys want to drop in there for me? Feel free to do so. All right. I think we're good. Okay, so let's talk a little bit about loan programs. I mean, a lot of this terminology you've already heard before. And so, whether you're doing a Google search on, products or whatnot, these are some of the core products that will generally come up in your search. So a conventional loan is going to be centered around Fannie Mae and Freddie Mac. Those are some, quasi-government agencies, I should say. There's a lot of talk, or there has been, it's kind of died down a little bit about, taking them, privatizing them, or even disbanding Fannie Mae and Freddie Mac. And so I think that's kind of died down a little bit, but ultimately they set guidelines for the conventional loan. So it's a minimum down payment of 3% for the conventional product. You can see the minimum credit score. Fannie Mae has eliminated their minimum credit score requirement, but there is a risk model that we look at that takes into consideration overall credit profile, time on the job, assets, things of that nature. Maximum loan amount has just recently went up. So there's a new conforming loan amount that's gone up to 832 for this year. That loan amount gets adjusted every year, right around October, just before we head into the new year. And a conventional loan does have the option to take a higher loan amount. It's called a high balance loan. So if you're looking to buy in LA County, for example, or Orange County, you can go up to $1,209,000, I believe, 750. But that does require a higher down payment. The down payment jumps from 3% to 5%. FHA loan would be the next product. That's a government insured loan, minimum down payment of 3.5%, lower credit score requirement, a little more flexibility to help equip our buyers with financing if maybe they've had some credit challenges or maybe higher expenses to income ratios. The maximum loan amount will vary based upon the area of the country that they want to purchase in. And then the jumbo product is not one that we'll see most first-time buyers get access to. They're just because of where the price point is at. But it does allow buyers to have a little bit more financing if they're purchasing in those higher price levels. The VA home loans for our veterans that have access to the VA home loan, it is a zero down payment option, minimum credit score of 620. There really is no maximum loan amount for a VA loan. And there's just a lot more flexibility in the guidelines for our veterans to get their access to home ownership, whether that's looking at expenses versus income, looking at the lower down payment option, and then with the conventional FHA, VA, and then we're going to talk about USDA. Those can all be supported by first-time homebuyer programs that we'll do and have a discussion on a little bit later in tonight's class. The USDA program is for clients that want to purchase in more rural areas. There's a no minimum down payment requirement. You can see the credit score requirement, and that maximum loan amount will vary based upon the buyer, where the buyer wants to purchase their home. With the USDA program, there are two requirements. It's the location. It has to be a rural designated USDA property, and there are household income limits for the product. All right. So that's a little bit of a look into loan programs. Now, one of the things that gets talked often about is mortgage insurance, especially for first-time home buyers, because it is an expense that comes along with the monthly budget of purchasing a home. So in our classes, we always like to talk a little bit about PMI, or private mortgage insurance. So what does it mean to me and what does it do, right? Now, in the lending space, there are two forms of mortgage insurance. There's PMI, which is private mortgage insurance, which centers around conventional loans. And then there's MIP, or mortgage insurance premium, that coincides with government insured loans on an FHA loan. Now, one of the things I did forget to mention on loan programs, and I had this conversation with a client earlier this week, FHA loans are government insured loans. So there is a residency status requirement, unfortunately, with this product. It just changed in the latter part of 2025, which basically means if we're going to do an FHA loan, you do have to be a permanent resident to access that program. A conventional loan, you can be a non-permanent resident, no problems there. All right. So unfortunately, those guideline changes came out in the latter part of 2025. So let's talk about the different kind of lanes, if you will, with mortgage insurance. Well, on the conventional side with PMI, private mortgage insurance, and MIP for that matter on the FHA side, essentially provides insurance that insures the lender against default by the buyer. So if something happened, there's a hardship by the buyer, the lender would be indemnified on that loan with that mortgage insurance. Now, PMI has different components that go into it that makes up the premium that you pay as a consumer. Things like down payment, credit score, what you finance. And as I can increase that credit score, as I can increase that down payment, now I start to see a lower premium in the cost of private mortgage insurance. Now, one of the features of conventional private mortgage insurance is that once I reach 2 years in my loan and I have 20 to 22% equity, I can apply to have the mortgage insurance canceled. Okay. FHA, we cannot do that. That's not an option for us. So if we were to look at the cost of mortgage insurance on a conventional loan, and I have a 740 credit score, and I'm going to borrow, let's say, $500,000 with that 3% down payment, my mortgage insurance cost is about $154 a month. So when you look at some of our calculators that we offer on our website, compare that to maybe what you see on Redfin and Zillow. There's quite a big difference because, on our calculators, we're looking at those different elements that make up the actual cost of mortgage insurance. If you do payment searches on Redfin and Zillow, they're quite a bit higher. So just kind of keep that in mind. We'd encourage you to kind of check out those calculators on our website to get really more accurate information. On the FHA side, two forms of mortgage insurance. There's monthly mortgage insurance, which is 0.55% of your loan amount. And then we divide that by 12 to figure out the dollar figure that you pay monthly. There's also upfront mortgage insurance, which is 1.75% of my loan amount. Now, mortgage insurance on an FHA loan is a little bit different than a conventional loan because we can only cancel the mortgage insurance by refinancing out of the loan. And really, I shouldn't even say there's not a cancellation option. You have to refinance out of an FHA loan into a conventional loan to get rid of mortgage insurance. So as I see FHA loans, it's generally more of the opportunity to access homeownership for our buyers because FHA has a little bit more flexibility in their guidelines, but it's probably the 2 or 3 year strategic loan to help us get into our home and then hopefully look to refinance into a conventional product down the road. When we look at the cost of mortgage insurance, you guys can see that on the bottom of the screen. We take that same $500,000 loan, we add in the 1.75% upfront mortgage insurance premium, which is $87.50, and then the cash amount on the monthly basis for the mortgage insurance premium is $229.16. So that would be factored into our monthly payment. I will say in working with clients all across the country, there is a big misconception that you have to put down 20% in order to do a conventional loan. But as you've heard quite a few times this evening in tonight's class, the minimum down payment is truly 3% as a first-time buyer. Now, there is a trade-off for mortgage insurance, right? But ultimately, you can still get access to homeownership on a conventional loan with a minimum down payment. And then certainly FHA is another option for us too, as well, for as a first-time buyer. Um, all right. So let's talk a little bit about qualifying income. And this is just one of those things I think it's helpful to know as you get prepared to apply for your financing with us. What are some of the things that I'm going to need to gather for documentation, right? And so we want to provide a little checklist to you here. You can see those past 2 years generally of income documents, whether that's tax returns, W-2s, and then a little bit, closer would be the 60 days of asset statements and at least 30 days of pay stubs. Okay. So that's generally what we want to see from a documentation perspective. But let's look a little closer at income, because I will say throughout the day, I get a lot of questions around, hey, Jason, does my income work? How would you calculate my income? So, when we look at income, there's a 2-year rule when we kind of look back at a 2-year history of income and or education. So we just have to validate that when it comes to loan financing. So one of the kind of scenarios I use a lot in class, which would be is, hey, let's say I graduated from UCR in the fall and I just started my job this month. You could still potentially be eligible for a mortgage because I can put together your past education and now your new job that you're working on with a $70,000 a year salary. We can use that to qualify for you on your mortgage right away. So you don't have to necessarily be on the job for 2 years. We just have to establish a pattern for the last 2 years. Now, if I'm self-employed, a little bit different. Self-employed, I have to show that I've had my business and filed tax returns for 2 years in order to have that eligible income for my qualifying for a mortgage. If I have, let's say, a variable compensation plan, I have my base salary, but I get commissions or bonuses, then I have to show I've been with my employer for 2 years in order to count that income for qualifying, if I want to use that in my mortgage scenario. Now, if I have two employers, let's say I'm in the healthcare field and I work for two different institutions. If I want to count both sources of income, then I have to show that I've been with both employers for 2 years. So that's where those kind of rules get a little bit trickier. If I have a situation where, let's say, I'm working for my W-2 employer 40 hours a week, but I got a little extra time on the weekend, so I drive for DoorDash or Uber. I make some income there. That is 1099 income that generally appears on your Schedule C for your 1040 tax returns. We can use that income assuming that you have been on both jobs simultaneously for the last 2 years. All right. And then the last thing I wanted to kind of share with you, because I get this question a lot too, is like, if I'm going to apply on the mortgage by myself, but my partner does contribute to my household expenses, but they don't plan on being on the application, then in that case, we can't include that income into the equation unless they plan on being a part of the mortgage. Okay. So hopefully that helps answer a little bit of the questions that we get quite often from clients. But certainly if you have some questions as we're going through tonight's class or a scenario that you want to run by me, let me know. One thing I did forget to mention to you that I get a lot of is, especially with clients that are starting new jobs, if you're going to start a new job, we can at times qualify you for a mortgage and at times also be able to close escrow on a home simply with an executed offer letter. We see that a lot with my clients that are relocating to different parts of the country where we're using an offer letter to qualify them with their employer. That can certainly happen with financing. Now, we also look at income that we validate and calculate out versus expenses that you have. Those expenses that we look at get put into a calculation called debt to income ratio. Now, the debt to income ratio factors in things like credit card payments, personal loans, car loans, and what your new housing payment is going to be. That housing payment includes the principal and interest of my loan, the property taxes that the house is going to cost, the homeowner's insurance for that home. If I'm putting less than 20% down, the mortgage insurance costs, right? So all of that stuff gets factored into debt to income ratio. And so we've put a calculation on screen for you that you can see. And this is an example of someone that's making $8,500 a month. And with the factors of the housing expense plus the other debts, they're paying $3,000 a month. So their debt to income ratio tells us that they're basically having 35.3% of their pre-tax income is projected to go out to those expenses, including the new house payment, right? And as I get questions from clients about debt to income ratio, they ask, well, Jason, what's the target? What should I be at? What's a smart buy for me, right? I would say someone that's buying a home with a debt to income ratio somewhere around 33 to 36% seems to be a really good comfort zone or sweet spot for our clients. But we're also in a high cost of living area, right? California is not the cheapest state in the country. So, we do see at times a lot of clients in 42 to 45% debt to income ratios. You can go as high as 50% for some credit borrowers in debt to income ratio. Now, it's obviously on the really high scale, especially when you look at your net income, right? Because we look at gross income when it comes to qualifying for a mortgage. But, some situations we have clients that maybe have other forms of income they just can't validate. So maybe their debt to income ratio, as we're calculating it, is a lot higher than what they're truly taking in with cash flow into their house. All right. So that's a look at income. Now I want to pivot a little bit. I want to talk a little bit about savings for homeownership. Savings is another one of those things that we have to work on to get us to the finish line when it comes to being ready to buy. First time buyer programs like assistance programs can get us there a little bit quicker, and we're going to talk about those in just a few minutes. But when we think about savings for homeownership, as a lender, we're going to validate where those assets are coming from. So that could be checking and savings account, can't be cash deposits. Anything that goes into your bank account has to be seasoned for 60 days in order for it to be used in financing. Now, you can also tap into 401ks, 403bs, brokerage accounts. Those are all allowed in financing. But we want to make sure that you have the conversation with your tax advisor or financial advisor first, because we don't want to create a tax event for yourself or obviously lose out in appreciation in the market, all those things that could happen with, accessing those funds. Gift funds can also be used in homeownership. That happens quite often where a family member is contributing to your home purchase. There is no seasoning requirements for gift funds, but there's some documentation process that we can walk you through. It's a pretty simple thing. Most products don't require a minimum initial investment by the buyer. So theoretically, you can receive all gift funds for your home purchase. Now, as you're building towards home ownership, and maybe just having enough assets is a challenge. And guess what? It's a challenge for all the buyers that we work with. We came up with a really simple savings plan approach to help you get to your home ownership goals a little bit quicker. And we have so many success stories with clients that have been able to kind of execute on a plan like this, which it's really easy. But ultimately, it's like looking at a situation where if I'm paying $2,000 a month in rent, I know I can afford $3,500 a month in mortgage payment, but I'm just not there to save for my down payment and my closing costs. What I coach our clients to do is let's start saving into our account like we're making a $3,500 mortgage payment. So the surplus that I have on a monthly basis after I paid my landlord is $1,500. That's going into my savings account on a monthly basis. And by the end of 6 months, I got $9,000 saved. I haven't factored in interest yet in a high yield account. But after 12 months, now I have $18,000. That gets us closer to the finish line when it comes to savings for homeownership. And it absolutely works. We've had several buyers in 2025 that used a plan like this, got themselves to a great spot from a savings perspective, and obviously got them to their home. So I would encourage you, try an approach like that. It is a super simple approach, takes discipline, but it can work. And it also gets you prepared from just a monthly cash flow perspective on what home ownership could look like for you. All right. So that's a look at savings for home ownership. Now let's talk a little bit about down payment assistance programs. And we are an expert in down payment assistance programs. We're actually the leader in first-time buyer programs in the state of California. Really passionate about serving our community with these types of programs because not all lenders offer first-time buyer programs. We partner with an agency called CalHFA, which is the California Housing Finance Agency. And that agency is designed to equip low to moderate income households with resources to purchase homes. There's a variety of different programs that are available, like the My Home Assistance Program provides 3% of your minimum down payment for a conventional loan. An FHA loan, you can get 3.5% for that minimum down payment, which can close up that gap of savings. And then essentially all we would need is closing costs out of pocket. Both of those products are 1% simple interest rate loans that don't have to be paid back until you sell or refinance in the future. So that's a great tool. You can add on another product called My Access, which provides 2.5% of your loan amount in assistance. That can also go towards closing costs or down payment. And then there's also what we call a ZIP program. We don't have it on screen here, but that's very similar to My Access. It can provide anywhere between 2 to 3% of your loan amount in 0% assistance. We are getting a lot of inquiries on a new program. It's not new, actually. It's in its third year of running. It's called the California Dream for All program. Provides 20% of your sales price in assistance or $150,000, whichever is less. That program is expected to launch sometime fairly soon here in 2026. And it does have a few kind of really important requirements to it. You do have to be a first-time buyer, and one of the applicants involved in the transaction has to be a first generational buyer. More information can be found on our website, and we'll pass along that link. Maybe I'll just have Ken drop that in the chat for you guys. You can check that out. We are currently pre-approving clients for that program. The way that program works, it's lottery based. And so what you do is you get pre-approved with a certified lender like us. We give you that pre-approval. When the lottery eventually opens, you go in, you set up a profile, and then that lottery window will close after 30 days, and then they'll select winners. That enables you to get access to this voucher that allows you to go out and start home shopping with the voucher. So I was fortunate enough to be a part of the creation of that program 4 years ago, and it's been a really successful program. If you're interested in that, we'll definitely get you more information on that. There are some national programs that we do, like Pathway DPA, that works with an FHA loan, GSFA that's right here in California. And Fannie Mae and Freddie Mac will also offer some low-income housing incentives for clients too. We have one of our programs called our 1% program that allows someone to purchase on a 3% down conventional program. If they contribute 1%, our company will put in another 2% to fill the 3% minimum down payment requirement. So there's some rules and guidelines to that, but we can certainly review that with you if you're interested in a program like that as well too. Okay, I thought I saw a question come in the chat. Okay, yeah, we did have a question come in. I'll just answer that really quick, and I'll show you a quick CalHFA example. Is the pre-approval valid for only 1 year for the Dream for All program? Ken's answering it too, but the Dream for All program pre-approval is a little bit different than normal pre-approvals. It just is enough to get you into the lottery. That's what that pre-approval is designed to do. A traditional pre-approval, which we'll talk about in just a second, is usually good for 60 days, but it can be recertified at any time. This is an example just for our audience, just to understand how CalHFA gets applied. So typically, if I was to buy a home with a standard conventional loan, and let's say I'm buying a $500,000 home, between my down payment of 3% plus closing costs, which we always estimate 2 to 3% of your purchase price, I probably need to save up about $27,000 to maybe $30,000. But if I was to add in maybe the My Home Assistance program, now I'm going to have $15,000 in resources for myself that can now shrink that down to maybe $12,000 to $15,000 out of pocket. If I needed more resource, then we can plug in the My Access program. So there's a lot of great assistance that's available to us now in today's market. But quite often, many people just aren't aware of it, right? And so as a leader in these programs, it's really our responsibility to really educate our communities on what's available out there to you as homeownership. Because I can't tell you how many times I'm working with clients and they come to me and they're like, Jason, okay, I don't have my 20% to buy a home, but I really want to buy for my family. How do I do it? And so that's where I think educational workshops like we're providing you tonight and just knowing what products are available to you, I think are a really important aspect of just being able to borrow smart for you as a consumer. Now, CalHFA does have some eligibility requirements. There's a minimum 640 credit score for FHA, 680 for the conventional product. If you are considered low income, which means you make less than 80% of the median income, then the minimum credit score on a conventional loan drops to 660. And then the income qualifications are based upon the applicant, not your household size, where most first-time buyer programs have that. So what I mean by that is if I'm making $100,000 a year and my spouse makes $100,000 a year, if my spouse is not going to be part of this application, it's just my income and expenses, then that's the only income that gets counted towards the income limits to the program. So all of the income limits on these programs are based upon 150% of the median income for that community that you're going to buy in. And you can use these products on any type of properties that are one unit, essentially. One unit properties like single family homes. By the way, single family homes can have ADU units or accessory dwelling units. That's absolutely allowed. New construction, condos, townhomes, below market homes that are available in communities across the state, and manufactured homes, assuming that that manufactured home is on permanent foundation. These are some of the income limits for some of our Southern California markets. If you're in Northern California, because a lot of our clients are spread out all across the state, we have some other income limits. Ken can drop those in the chat for you guys as well. And then a question came in before I go into workflow of the home buying process, which would be, would my monthly payment go down if I'm thinking of buying a home with an ADU? Would I be able to include what I expect to receive when I rent it out? So if you purchase a home with an ADU and you want to use a first-time buyer program, then we can't count income to qualifying. Your payment, by the way, is going to be the same regardless, right? You can't reduce your monthly payment because you have an ADU that you're going to rent out. Now, can you get income from the ADU to offset or to pay towards your monthly payment? Absolutely. But when you're doing a first-time buyer program, we can't use that stream of income. Traditional loans, yes, we can. All right. Good questions from our group. You guys are coming out strong for the new year with our first class, so I love it. Okay, so let's talk about the buying process and as we go through our last topic of tonight. So, I get a lot of questions around this, like, Jason, where do I go from here? I don't even know where to start. I looked it up in ChatGPT and I still don't really figure out what's happening. So we want to provide you with a visual aid on, like, where do I start from class after I leave class, right? So I hope you guys have a few takeaways from tonight's class that have been aha moments for you. But as we work out of class, now we want to get connected with you for our free consultation service. Now, we're going to build a strategic home buying plan for you. And then what comes out of that would be pre-approved for your home purchase. Now, that kind of sets the stage for step 2, which is house hunting. And so the pre-approval, and by the way, I just answered that a little while ago, but that pre-approval is good for 60 days, but I can always make adjustments on the pre-approval as you're out going out and looking at homes. We ultimately want to just provide a baseline for you with the pre-approval and then make adjustments as you're seeing homes out in market that you like. Your search probably has started online for homes, but then once you get kind of filtered down into a community or a type of property that you're looking at, I would encourage you to talk to a realtor who should be an expert in your local market that you're interested in. We do have a fantastic network of preferred realtors that I introduce clients to all the time. We can always make that connection whenever the time is right for you. But those are ultimately realtors that align with our vision and values and how we want to treat our customers. But as you're out house hunting, you're going to hopefully identify a few homes that you like. Once you find a home that you want to maybe take a shot at, make an offer on, the realtor would help you with that. If the offer gets accepted, then we move to step 3, and that's called entering escrow. So what that means is you have an agreement with the seller that says, yeah, I'm going to buy your house, right? And that contract is going to set some parameters of that contract, of the transaction, right? It's going to tell you, when am I going to close escrow, meaning when I'm going to get the keys to my house. You're going to have protections in that contract, which we'll talk about. But after that acceptance has happened, you're going to get a call from me saying, hey, congratulations, your offer's accepted. Let's talk a little bit more about financing. Let's schedule you for your follow-up video session so you can, start understanding how this is all going to come together. We're going to give you a home buyer checklist that you can start working on some follow-up documentation. Now, as we move through the process, step 3 is going to be some of the administrative, step 4 is going to be some of the administrative tasks of your loan. You are going to be required to make an earnest money deposit whenever your offer gets accepted. An earnest money deposit is usually 1% to 2% of your sales price. Now, that amount of money will count towards your out-of-pocket expense for the home purchase. And in a contract in most parts of the country, including California, you're going to have contingencies in your contract, which allow you as a buyer to do your research on the property once you're under contract, to get the house appraised, to make sure the house is worth what you're buying it for, of course, getting your loan approved, and probably get some inspections done to make sure the house is in the condition that you expect it to be. Step 4 is going to be more of the internal things that we do as a team, things like verifying your employment, verifying assets, making sure maybe all your first-time buyer disclosures are done correctly. As I mentioned earlier, we're going to connect with you on the day that we get word that your offer's been accepted, but we're also going to do a follow-up video session with you. We call it our follow-up consultation, just to make sure everything is designed properly, show you some different product options that might work for you. So we make sure we've kind of fine-tuned everything for you. All that has happened now within the first week, maybe 10 days of your contract period. Let's say an example like we have here, you had your offer accepted here at step 3. Well, step 6 is going to be the end of your 30 days. So that's the date you get keys to your house. Now we're doing all these things of step 4 and 5, all in between those 30 days. You'll be getting push notifications as we move through these different milestones. Step 5 is a big milestone because that says, hey, your loan has been approved. We also probably have the appraisal back in the process. And now we're going to start kind of fine-tuning things to get to the closing process. Now, one thing that I always like to share with clients is that interest rates, which is a really important element of your payment, right? It drives the monthly payment. Interest rates change by the minute throughout the trading day. Once you go under contract with the seller, we're going to be strategically watching the market to try to understand what's going on economically and how to best time the market. like I shared with you during our interest rate commentary today, like interest rates got better in the afternoon. So a lot of our clients that are in contract right now, we're going to talk about maybe locking in interest rates tomorrow because we're going to see a better interest rate market tomorrow in the financial world. So now we've gotten past step five. Last thing we're going to do at step five is get you your final closing disclosure. By the way, at every step of the process, you're going to be getting disclosures that are e-signature disclosures that you'll be acknowledging receipt of, that'll highlight all the numbers in your home purchase. Step six is when we have to do the last in-person component of the home purchase. You're going to be signing final loan documents with the public notary. That process takes maybe about an hour to an hour and a half. You'll also be delivering your final funds for the transaction on that date. And then as your lender, we're going to be wiring in the funds for your financing, whatever that looks like. Maybe you're selecting a first-time buyer program. That money gets all reconciled by an escrow team, and then they'll record documents with the county recorder's office. They record what they call as a grant deed to transfer ownership to you from the seller to you, the buyer. And then they record a deed, which is your loan, essentially the agreement for your loan. And what'll happen is that'll be all confirmed with the county. And then we get to say, hey, guess what? You're done. You are now a new homeowner. So that is the final stage of the process. And that is certainly a day of celebration. I get a chance to make calls to congratulate our clients at least 2 or 3 times a day. That's like my favorite part of the day. But our relationships don't end with our clients at that point because we have a really kind of comprehensive aftercare program after you get the keys to your house. We want to provide you tools like our HomeBot system so you can kind of measure what's going on with home equity in my home. Does it make sense to refinance my home? We haven't really talked about that in today's session, but as homeowners, you will now have the opportunity to refinance your home. So as rates go lower, the consideration of, hey, I want to try to lower my monthly payments. So maybe the time could make sense for me to refinance. A lot of our clients that bought, if you looked at that rate chart earlier in our discussion, like clients that bought in the 7.25%, 7.5% interest rate days where it was really high. Now we're having those conversations with them about refinancing their homes. And we're always checking in with our clients on an annual basis, just making sure they're having all the tools that they need to be able to make great financial decisions down the road. It's not just a transaction for us, truly is a relationship over time with us. Now, if you're thinking about moving forward in the process, I love to be able to partner with you on that journey towards homeownership. So I spend most of my day consulting with clients, and we do 30 to 45-minute sessions with them to design a strategic home buying plan. It is a free consultation that we do for you coming out of this class. It does require some action items on your side. You'll have to do an online application. We only do a soft credit check. You'll upload some documents. And then we have a really kind of, I think, pretty user-friendly scheduling system. You'll just kind of click on here, pick a good time that works on your calendar, and then we would block out 30 to 45 minutes just to kind of go through that plan together. You don't have to plan on buying in the next month, 2 months, maybe not in the next 2 years. We just want to be a resource for you to help you achieve your goals of homeownership, whatever that might look like for you. These are some of our talking points in our consultation, and it's very similar to the discussion we've had in this evening's session. So it's going to look very similar to that. We really embrace technology with our team here. So we have different tools that utilize AI when it comes to looking at like market data and stuff like that, or different tools that we can help provide different scenarios for you. But on the mobile side of things, you can start the process right via mobile. You can do calculations right from our mobile, also follow the progress of your loan. Technology is great. It doesn't replace the human touch of our business. And I think that's one of the things we're really good at, is just making sure that we're here for you as a partner, whether that's email, text, or just a simple call. We want to be here for you on this journey. In case you didn't know, as part of our UCR partnership that we've had for the last several years, we also discount our services for you. So whenever you decide to work with us, of course, you have access to these free classes 3 to 4 times a year. All these classes are always up on our YouTube channel for you guys to check out again. And if you like our content, feel free to share with friends, family, coworkers. There's other partnerships like this that we do in other parts of the country. Feel free to share that with your friends and family. I think it's pretty useful content to help you on this journey. And finally, here's all my contact information. So feel free to reach out to me, any questions you have. I know I had a couple questions pop in that I'll get to in just a second. But you can just reach out to me through one of those means. And those are all our socials. Feel free to check out, what we're sharing out there in the local communities. A lot of stuff on our Instagram, especially as we're doing with CalHFA, and some of the kind of the timeline for Dream for All is out there. And a lot of what our clients are saying about us in our Reddit communities, just love the testimonials and just encouragement we get in our local communities. It really means a lot to me. So with that said, this kind of brings us to the end of our class. We got a minute to spare, but we're going to stay as long as we need to answer questions. I got some questions already in here, so we'll field all these questions. Again, we have recorded tonight's class. We're going to push that back out to you tomorrow, along with our slides from tonight's session. So let's take the first question, which is, you had mentioned putting money in HYSA, high yield savings. Okay. High yield savings account earlier on in the year. Do you have a recommendation on some companies for high yield accounts? Currently, I use Amex, but want to see if there's any alternatives. I'm not a big aficionado when it comes to high yield accounts. I too use American Express. It works, it's convenient. But I would check out some local banks. There's probably some credit unions that are probably enticing with some high yield accounts. Those high yield accounts are going to start coming down, especially as the Federal Reserve lowers rates. But take advantage of it while you can, especially as you're building that savings plan. Is there a required homebuyer education course needed for the CalHFA program? Yes. There's a standard 8-hour homebuyer education course. Doesn't need to be done now. We just ask that you do that by the time at least you're under contract with a seller. So that's for the standard CalHFA loans. If you're interested in doing the Dream for All loan, there's a 1-hour shared appreciation class that you'll need to do. That is a prerequisite to apply for the lottery. The 1-hour class is free. The 8-hour class costs $99. It's an online module, and modules, I should say, and then you'll do a follow-up call with an instructor. So we can get you all the details to that as well too. We'll probably put that in our slides for future classes. And then okay, so we had a question about HOAs. Can you talk about HOAs and whether these costs are required to be paid? Also, what is the impact of property taxes on the decision to buy a home? So if you're going to buy in a community that has an HOA, not an option. You're going to have to pay the HOA. HOAs are designed to put resources into the infrastructure of your community. So if you're buying a condominium, hopefully it has a really cool gym and some other cool community areas and whatnot. But it's also for the financial health of the community, upkeeps on maintenance, insurance costs, stuff like that. HOAs are under, they're kind of a little under scrutiny right now because insurance costs are really high in California. So we've seen a lot of HOAs that are kind of struggling. There's also what we call SB 326 to make sure that they're doing upkeep with some of the railings and stairwells of some of these communities, and sometimes they're not equipped properly financially. So, HOAs are part of what you're going to get in those type of communities, and they get factored into your qualifying debt to income ratio as well too. Property taxes are part of also your housing expense. Property taxes vary by the community that you're going to buy in. So, if you have an older established area, it probably has a lower tax rate than versus the brand new community that has all the bells and whistles, the new schools, the new fire department, because some of those newer communities have a thing called Melrose taxes that go into bonds that pay for all of those fancy things in those communities. Okay, so property taxes are certainly a part of that element. And I think ultimately the decision on buying a home, property taxes is one element of it. I think it's just going to have to be, does it fit within my monthly budget scope? Is it something that's going to work for me? And so those are things that we'll kind of, you and I can talk about as we build a plan for you to home ownership. Okay, great questions tonight, guys. Appreciate that. I know quite a few of you are still in the session, so let me just do a quick once over. I want to make sure I didn't miss anything. Okay, I think I got it all. All right, and then we owe you guys some links that we can get out to you. We'll get you the home buyer education links. You guys can check that out. And then I think we had a couple other things that we'll get out to you as follow-ups in our email distribution. We have a lot of folks that signed up for tonight's class. So maybe not all of you got a chance to attend class, but like I said, we'll get the recorded version out to you. That'll be up on our YouTube channel. And then if you guys are interested in that Dream for All program, so I know many of you are in California, if you feel like you might meet the requirements for that program, we are teaching a class next week on the 20th at 6 o'clock. This is a live class on Zoom. I'm going to do it with one of my colleagues at CalHFA, Leanne Walker. Her and I are going to kind of tag team that session. So if you'd like to join that, that's a free session we're providing just to make sure we have a deeper understanding of Dream for All. We'll kind of share some experiences, if you will, of what we've learned in the last couple of years with Dream for All, what we're expecting with this upcoming release of Dream for All. So if that's something you're interested, love to have you in that class. And certainly you're welcome to come with any of our future classes as well too. So with that said, I'm going to let everybody get back to their Wednesday night. Hopefully you enjoyed tonight's session. I appreciate you spending our first class for 2026 with us, and look forward to hopefully seeing you guys soon in one of our upcoming consultation sessions. Talk to you soon. Good night.